Welcome back to another video update, guys. So before I begin this particular episode, there are 5 points I want to state before the video. Point number one, what I'm going to present to you does not mean that I am bearish on the market. Point number two, I'll give you reasons why this market needs a serious cool off and why currently a lot of short-term greed is chasing stocks in the market. Point number three, no one can catch tops or bottoms in the market, and that is why strategically everyone has to decide what is the time to participate, what is the time to hold positions, what is the time to take partial profits or maybe 50% profits or even higher, and then how one needs to reassess what is happening in the market. Number four, why risk reward is in the long term only currently. There is no risk reward in the market in the very short term. And number five, market is currently in an exuberance phase where everything is just heading up. And this is not an India specific trend. It's a global trend. And of course, I'll along the way speak about few things that I've been doing. So the first slide we'll go through is global market charts year-on-year performance. That is from June 2023 to July 2024 or June 24. So the first chart that you see is understanding the global trend in the market. You look at US 100, year-on-year, it is up 31%. US 500, 24%. Sensex, 22%. Japanese, 21%. Netherlands, 20%. Italy, about 20%. Then you have, I don't know which country is this, another 15%. This is Europe. US top 30, 15%. Spain, 14%. Germany, another 14%. You have Toronto index here, about 9-10%. And then you have, Australian market at 6.42, Brazil at 4.2%, France at 3%. Then Mexican market at 4.5 negative, Shanghai negative 8%. The thing you got to understand here is that the numbers that you're seeing, positive 30, positive 24, positive 20, positive 15, 18, 20, this is usually what you get in a really, really, really good year. All right. And from last June, July to current June, July, we have already hit that number. If you look at American specific markets, Argentina market is up 200%, Peru is up 30%. Again, look at the numbers here. Leaving aside something like Brazil, Mexico, Ecuador, these are on the lower end, but most of the markets are north of 10%. You look at Asia, ex-China, again, Pakistan Stock Exchange is up 85%. You have Taiwan up 34. You have India 25, Japan 21. Again, majority of these countries, Vietnam 15%. You have Indonesia again up 8-9%. Majority of these countries, major economic countries in Asia, are north of 8 to 12% at least over the last 12 months. Stocks, of course, closer to higher double digits, triple digits. Australia specific markets, look at Australian market performance. In Africa, look at the market, 60%, 37, 16, 14, 12, 10. This is a global trend that is there everywhere. Look at Europe, 70%, 45, 41. Denmark is 40%. You have Spanish markets up 34%. Euro stocks, which is usually a culmination of most of the European stocks, major stocks in the market, up close to 30%. These kind of returns are what market delivers in excellent economic conditions, a lot of political stability, no war-like scenarios, those kind of things. There are plenty of problems currently in the world, but I'll come to that later. Even the worst performing market, this Great Britain, recently elections got over 9%. I don't know which country is that, CH20. I think it has to be the Swiss markets. It's up about 7.38%, much higher than what investors get there from various different assets. Now look at the commodity prices. Year-on-year commodity prices. You take at uranium, crude oil, menthol, Brent, heating oil, gasoline, coal, UK gas. You look at precious metals, other kind of commodities. Why I've written sticky inflation? Because a lot of central banks are saying, and they are much knowledgeable than me at least, that inflation is going to come down in the last quarter of this year, first quarter of the next year. When I look at the commodity prices, when I look at the freight charges that are going on across the world, when I look at the port related transport charges that are there, I just can't see how inflation is going to cool off. But again, I have to make a disclaimer here that central bank people obviously know a lot more than what I can ever imagine. But my common sense tells me that inflation is going to be a lot more stickier than what we have seen in the past based on the commentaries from various central banks. It's only Reserve Bank of India that is alerted about this, that they need to have a wait and watch approach with respect to inflation. The battle is not over. I think their target is about 4%. Currently, the price, that is the inflation index, is at 5.1 or 5.2%. So now the US market. The thing is, US market is heading higher, and a lot of analysts you'll hear saying that stability is returning to US market, and how it is bullish. If you look at the US market, by the way, this orange, yellowish orange line that you see, this is year to date return. The blue that you see is 1 month return. So Apple has given year to date 2%, but in 1 month it has given 8%. Nvidia 144% in the year, 35% in the month. Meta, that is Facebook, 42% in the year, 7% in the month. I hope you get the point. But this is the reason why US markets are holding up. If you look at the broader market charts of US markets, they're just not performing that great. So US markets are mainly up because the leader, that is the sentiment, is set by Nvidia, and most of the other stocks are actually following. Nvidia and SMCI, I think that is the name, semiconductor name. Now, pay attention to this. This is July 2024 snapshot US market, 5th July. What are you seeing here? What you are seeing is the technology and communication, largely driven by the names of likes of Nvidia, etc. These are the sectors that are highly skewed in terms of returns and are giving a relative perception that things are great in the US market. But if you look at the data of the US market, majority of sectors are between 4% to 8%. Material sector, healthcare, energy sector, consumer staples, utilities, financial, all are somewhere here. Now, looking at this chart, you would say, what is wrong with this? Because this seems to be the leader, and this seems to be a space where relative stability is there, but it is clearly not as strong as something like a technology or communication kind of a sector, right? Okay, next slide is this particular data on April 2024. On April 2024, most of these sectors were delivering good 1 month return, plus the year to date return was also more uniform, which means the technology sector was here, communication sector was here. This tells you that there was a broader market participation in the US market between March, April. The recent data tells you that broader market participation has kind of faded away, and currently only 2 sectors or broad themes are holding the market. Now, why these 2 charts are important? Because if you go to August 2023, this is what was visible then, with a lag of 20 to 40 days, which means the chart that I shared today, in the next 20-40 days, it might begin to look like this, where the communication and technology funds back then were doing very well, exceptionally well, which gave you a perception that US markets were great, but majority of sectors were between 0 to 14%. In this case, it was between -2 to 6%. And then from August to the end of the year, US markets started struggling a lot. A lot of technology related stocks also started heading lower. So there is a possibility that this might repeat. And this comes on the back of the data that we saw earlier. That is that majority of assets across the world have risen a lot in the last 12 months. Even year to date performance of majority of assets is something that you get in really good years. Now let us come to domestic sectors, that is our sectors, year on year performance. So let me explain this chart to you. This is the sector sector name, the closing price, the last 1 day change. I think this was taken a couple of days back. This that you see is the yearly range, which means if you look at the chart, PSU bank sector, this is the top end of year range. It is at, let's say, 80%. It is still about, it's far away from the yearly highs. I hope you get this chart. Look at media chart. It is well away from the yearly range high. But look at most of the sectors. Most of the sectors are actually at yearly high because the markets have been so bullish. This is actually not the case in the US market. In the US market, only technology, utilities, technology and telecommunication, that kind of space is towards the yearly high. Why I've written no, it's not different, because you may want to hear that after a 30% rise in sectors, that data I'll come to, it's entirely possible that sectors can go up. Domestic money is coming in. It's different this time. We are not dependent on FII money and those kind of things. Let me tell you one thing very clearly. If US markets from here on the next 6 months head into consolidation, there is no way our markets are going to go higher. They are also going into some time or price correction. But the data needs to show up. Currently, all this is opinion. All right. And opinion often can get you into trouble, but you have to confirm the opinion by looking at charts and tracking basic things like where prices with respect to 50 DMA, what kind of base is getting formed, what kind of leadership is there in the market, what kind of breakdown is happening in the market. Those kind of data points you have to see. So this is a 1 year domestic sector performance chart, that is from July 2024 to July 23 to 24. For those of you who cannot see, if you're seeing this on a mobile device, CPSE, Realty PSE is up 112, 113%. Microcap is up 64%, small cap 61%, energy 61%, auto 59%, PSU bank is up 56%, India manufacturing is up 60%. Look at the returns of majority of sectors here. Even a laggard like Nifty Bank, private banks are up 26, 30, 35%. Service sector, IT, which has virtually done nothing, is up 40%. So we are heading into the next 6 months where a lot of returns already are front-ended in this particular first 6 months of the market, that is. And can you see this? Can you see this up and down movement? Again up, then again sudden down, again up. It moves like a wave. Can you see this? So currently we are in an up wave. Can we head another 10, 15, 20% higher? Who knows? Today Nifty is at 24,000. Can it become 26,000? Yes, it can. That is why this video is not about you have to sell today. This video is about, if you went through the title, that why one should be thinking of pulling some money out of the market. And that sum is different for everybody. For some who's in the market since 2020, that sum would be north of 50, 60, 70% also. For someone who has just had a recent exposure to the market is up 20%, should one be thinking about pulling 10%? Well, it's everybody's judgment call. All right. But we are currently in a good kind of a phase and good kind of a cycle in the market. Remember, when prices fall, in this space is when people should be thinking to buy, but they actually sell here. When price moves up, this is where they should be thinking to sell, but they buy here. That is how stock market cycles work. One interesting chart I'll show you. The same chart, but in an inverted manner. Why sometimes inverted chart helps you is because if you can see, there has been so much of deviation, vertical kind of deviation on the downside. It is entirely possible now we do this, remain in a range, and then see what happens. Either more correction or more upside movement. All right. So these inverted charts actually are very helpful to see what may happen in the market. It's always about what may happen. Now coming to the market breadth. Now, this is a chart that I've consistently shared with you. Now, number of stocks below 50 DMA in March were about 80% stocks. Currently, it is down to only about 6, 7 or 8% stocks below 50 DMA. This is again not a predictive indicator, but it tells you the mood of the market. Majority of people are already in the market. What about number of stocks below 200 DMA? In March 2024, that number was as high as 65, 68%, which was that people were getting shaken out. March was not great for the market, precisely when everybody should have started looking at the market. What is that number today? It is down to 5%, which means majority of the stocks in the market are actually above 200 DMA. All right, again, historically, look at the charts and see if that is the time when you should be, bringing in new money in the market, or bringing a large corpus or investing in some places, some hot spaces in the market. We all know which are the hot spaces, the really strong momentum kind of phases or spaces in the market, which I covered in the last video. Also, a clear distinction, which should be the momentum sector, which should be the SIP kind of a sector. And if you go through the list and see what has happened in the last 20 odd days that I released that video, some of the pockets in those spaces have actually doubled also, some stocks. Before I would release my next video, and I would do it when I feel there is a need for an update to come out. Okay, so that can be next week also, or it can be 2 weeks down the line also. Keep your notifications on, because my videos will rarely get suggested. So what is the outlook that I see? See, the first thing I would tell you is that whenever it is getting too easy, watch out. This is what I've written. It's just getting too easy currently in the market. And whenever it gets this easy, start getting worried. Tighten up your stop losses. Don't use leverage, and preserve whatever money you've made. Time and price correction. What I feel is the next 6 months are going to be very different from what we've seen in the first 6 months. And for markets health, I think it's good that we will have some time correction. I would personally also want some price correction, 10-15% price correction. That would cool off some of these really overextended sectors in the market. Plus, there is US election also coming up. A lot of things are happening in the US just because of elections. I'm sure you guys are also tracking that. So, it's but natural for markets to get worried at some given point in time. One thought process is that President Trump, if he returns to power, market will take it positively. Another thought process is that President Biden is not fit enough to run for the office. One more thought process is if President Biden withdraws, who comes into the picture? There is going to be uncertainty in the US market. It is just that it's not showing up currently. The next is the short-term momentum phase. Such momentum phases last for a few more months. Expect nasty shakeouts, but then again a trending move post that. It's going to be difficult, painful. Last phases of a mini bull cycle within a larger bull cycle are volatile. Easy trades are no longer available. So I personally think we are still in a long-term bull cycle. A long-term bull cycle can go from 2020 to 2045. But within that long-term bull cycle, there will be periods of mini bull cycle and mini bear cycles also. I feel if a bull market mini cycle was a 100-minute movie, I think 80 minutes are done. The last 20 minutes are left. And then there will come a mini bear cycle, which will be either a time or a price correction kind of a cycle. That is what at least I feel in terms of market outlook. All right. So I have if you have queries, you can reach out to me on Insta DM. Last time I answered majority of questions. Obviously, I cannot chat. I also have limited time, but you can reach out to me, and I'll definitely look into your query. Please keep your questions concise, because there are last video I received over 144 Insta DMs, and some of them were really lengthy. It is very difficult to answer those questions. Keep your queries concise. I'll definitely get back to you. All right. Take care and be safe.